If you're sick of being emotional, second-guessing yourself, or losing money trading, there could be something missing: market structure. And market structure is just the way markets move. And understanding this is important to help you trade more profitably and make more money. And so in today's video, I'll be breaking down the secret way to see market structure and 3 common mistakes to avoid. But first, we have to understand, what is market structure? Market structure is just the way markets move, and it usually consists of 3 distinct phases. And without understanding this, you're basically eating an apple like an orange. During uptrends, we have higher highs and higher lows, indicating bullish sentiment. And the opposite of this is downtrends, marked by lower lows and lower highs, indicating bearish price action. And in between the two, there's usually a consolidation phase, so range-bound price action, indicating indecision in the markets. And these trends consist of impulses and corrections. And during impulses, buyers step into the market, pushing price further up. And when buyers take profit, this leads to a pullback or a correction. And when price drops and reaches a more favorable price, buyers step in once again, pushing price further up, leading to another impulse. But why do these phases even occur? Well, the markets operate as an auction process, as there has to be some sort of a balance between buyers and sellers. And now that you've mastered the basics of market structure, let's start with common mistake number 1: misidentifying highs and lows. Focusing on every little price fluctuation like this can just lead to confusion. And so what I would recommend doing is actually focusing on the major waves of price like this to gauge the overall trend direction, which is a downtrend in this case, especially as markets operate across various timeframes. Now, the next mistake is confusing external structure with internal structure. Recognizing the difference between external structure, which is the primary trend, from internal structure, so the minor moves within this much bigger trend, is crucial. So say, for example, we're focusing on the 4-hour chart for this primary trend. Well, within this, there would be much smaller waves on the lower time frame, like the 15-minute chart, which would present with shorter-term trading opportunities. But of course, real life is very different to textbook. So let's head over to the charts. So looking at this 4 euro-dollar chart, we want to focus on the external structure, so the major waves of price like this. And over the years, I've noticed that many clients that come to me for help, initially, they focus on the noisy price action in between, so the internal structure like this. But focusing on the external structure, so the major swing points instead, will make your life much easier. So as you can see, this is a 4-hour downtrend with lower lows and lower highs. Now, of course, you can take advantage of these minor pullbacks, which would have 15-minute counter-trend long opportunities, before then riding the overall 4-hour downtrend down. Now let's look at another example using this 4-hour pound-dollar chart. It's very easy to focus on every little wave like this, and that just leads to confusion. What's more ideal is focusing on the major waves, so the major swing points like this, which is the external structure. Now, of course, you can take shorter-term counter-trend short opportunities here within the internal structure, but trading in alignment with the overall 4-hour uptrend in this section of the chart will improve your win rate. Now, as you can see here, there's a lower low here, and this is a trend change from the initial uptrend to a downtrend. And so we can mark this as a change of character. Now, one thing to consider is that there has to be a confirmed candle close here below this low for us to say this is a downtrend. If it's just a wick below here, it could be a fake out or a liquidity grab. But overall, applying the concepts of market structure, we can actually take a more precise short opportunity here on the 15-minute or 1-hour time frame to get a more precise entry 4-hour short in alignment with this 4-hour downtrend. If you are still finding it difficult to identify market structure, here are 2 practical tips. Firstly, avoid frequently zooming too far out because there's no end to looking back. And secondly, I would recommend focusing on the most recent price action. And something that I like to do is to start from the right and move to the left, because I've noticed that many traders just zoom out far too much, which just leads to analysis paralysis. Now that you have mastered external and internal structure, don't dismiss mistake number 3, which is ignoring the fractal nature of the markets. The markets move in such a way that the patterns on the higher time frames, like the 4-hour, are actually repeated on the lower time frames, like the 15-minute. The only difference is that the patterns on the lower time frames are much noisier. Now, looking at this chart, we can see it's a 4-hour downtrend with lower lows and lower highs. And if you zoomed in on the 15-minute chart here, price action would be similar, but just much noisier. And if you entered short opportunities here on the 15-minute chart, you would have a high chance of winning given the high time frame alignment. But it's important to identify the overall market waves to maintain clarity on the trend direction, but also avoid overanalysis. So identify your structures and stick to your trading plan. And if you found this video helpful, but are sick of losing money, being emotional, or second guessing your trades and want help with your trading, then click the link in the description below for your free call to see if I can possibly help you. And YouTube thinks this video will help further improve your market understanding. Let's see if it's right.